Warren Buffett, How to Invest for Beginners. Hello, and welcome to our channel Pursuit of Wealth. This channel is your ultimate destination for learning about finance and wealth, investing in crypto, informational and educational trends in finance management. If you are someone who wishes to become wealthy and are looking for smart money management options, then we are fortunate to have found each other. If you are looking for a successful investing career, then this video is for you. Well, seeking the advice of successful people can help you achieve your objectives. What's the first word that comes to your mind when we mention the most successful investor? Yeah, you got it right. That's Warren Buffett. Today's video is about the CEO of Berkshire Hathaway, who is also known as the Oracle of Omaha. This man is famous for his investment success, and his advice can be helpful, especially for beginners. He also has a famous saying that you can make money by listening to the advice of an experienced person. Well, we will discuss the investment strategies of Warren Buffett that can help you excel more in the field of investment. Before we proceed further, like this video if you want more informational content. Let's start our video with Warren Buffett style. As he says, let's open the guide to investing for beginners without wasting any time. Here are the top 12 Warren Buffett tips of investment for beginners. Number 1. Do not invest in a business that you do not understand. Every tip by Warren Buffett is a gift to beginners. This is another useful tip by him. Well, investing is a world of marketing. Companies hire people to spread the good word about them. This is a modern way of trapping a human mind. It's in the habit of humans to trust the reviews of people around them. And this trap can lead you to an investment scam where you are expected to lose your hard-earned money. Buffett claims that before investing in a business's shares, you must first comprehend how the firm produces money and the major industry drivers in less than 10 minutes. If you cannot understand it in 10 minutes, move to another firm to analyze. You should completely research the company where you are investing and be aware of the place you will give your money. Knowing the firm might help you predict whether there will be any linked economic challenges in the future or not. You don't have to be an expert in understanding and analyzing the stock situation of a company. Even an ordinary man can easily understand the psychology behind knowing about the firm in the stock market. Warren Buffett advises against investing in firms you don't fully understand. Number 2. Self-trust is the key. You might have seen businesses making huge losses. The reason is a lack of self-trust. You can't sell your product until you trust your capabilities. The investment case is similar. While investing as a beginner, you will always have doubts about your selection. The first step toward investing as a beginner is to believe in your investment decision. You will probably get thousands of people around you calling your decision wrong, but you have to block your ears and trust yourself. Forget all the fears and think positively. Believe in yourself to get successful results. To set yourself out from the pack and be a winner on your own, acquire knowledge and make investing decisions. Number 3. Diversification isn't always appreciated. If you have done some basic research on investing, you know the importance of diversification. Almost every investor recommends it. But Warren Buffett declined to go with the flow. According to him, Warren Buffett believes in self-trust. Diversification is for people who lack self-trust. You need to trust yourself and look for long-term investment opportunities. Warren Buffett calls diversification a shield against ignorance. Some investors diversify their portfolios to avoid a single stock sinking their entire portfolio. Nevertheless, it makes it more difficult to maintain concentration on individual assets. Diversification minimizes your focus on individual investments and reduces the volatility of one's portfolio. Diversification also impacts the viewer that the person is less confident about his investments, which may strain oneself from quality investment holdings. Number 4. Quality stocks are better than cheap stocks. As a beginner, you will be attracted to cheap stocks. Your inner self will insist you buy the affordable stock and rely on luck for it to be profitable. Investment games don't work on feelings. You have to stop that cheap tag from getting on your nerves. Warren Buffett recommends beginners choose quality. He said, purchasing a fantastic firm at a reasonable cost is preferable to purchasing a good company at a high cost. You can still argue about the authenticity of cheap stock, but remember, you are at a higher risk of losing money in them. If we talk about investment in fairly valued stocks, such stocks are usually more costly, but they have the least crash record, so it's safe to invest in them. Number 5. Consider yourself an owner. In his interviews, Warren Buffett constantly states that thinking like an owner affects your perspective on stock investment. Consider purchasing a stake in the convenience shop around the block from your home. You'll automatically consider the suppliers, competitors, pricing, etc. You'll need to consider both the geographic area and the market's competitive position. After analyzing everything, you'll select which one to buy. Stocks, too, should take the same approach. You're not just buying a piece of paper when you buy a stock. Purchasing a company's stock entails acquiring a share of the company's ownership. You must consider all factors before making a purchase, just like the business owners do. Number 6. Seek a safety cushion. Buffett's investment philosophy emphasizes the need to maintain a margin of safety. In layman's language, a margin of safety is a feature of an investment that protects investors from losing money. If a stock trades for $20 per share, but the company's assets are genuinely worth $24 per share, there is a $4 margin of safety. The inherent worth of the assets should prevent a large drop in the stock price of the company. Buffett's goal in every deal is to pay less than a company's basic worth. An excessively high purchase price for a great company's shares might undo a decade of favorable business achievements, he claims. A quick reminder, if you've enjoyed the video so far, consider subscribing, as we frequently upload such informative and educational videos. Let's continue. Number 7. Discover the fundamentals of value investment. Warren Buffett is largely regarded as the top value investor in the world. Value investing stresses paying modest prices relative to their genuine worth when it comes to assets. A value investor's goal is to buy $50 worth of a company's stock for less than $50, preferably much less. Value investors seek and invest in companies with intrinsic values that are much greater than the enterprise values indicated by their stock prices. Buffett and other value investors think that the market will eventually recognize a company's actual value, increasing stock price and a return for the value investor. Number 8. Don't leave it to chance. Well, a smart investor will never make the mistake of investing in a company just to forget about it for a longer time. That's why Buffett is considered one of Wall Street's most active value investors today. Any victorious investor makes the effort and time necessary to maintain track of their assets and rebalance their portfolio. Examine your portfolio frequently, ideally one time a month. Look for any stock that no longer satisfies your criteria for investing. Perhaps the value has increased to the point of overvaluation, the management team is changing for the worse, or the firm's intellectual property has been challenged in court. If the conditions of a firm change and it no longer satisfies the criteria for value investment, it may be time to sell and move on to the next opportunity. Anything can happen in the market. Buffett monitors his investments constantly to ensure he doesn't skip anything. It would help if you did the same. Number 9. It is forbidden to be emotional. Some people should not own stocks because price swings upset them. You shouldn't have stock at all if you're going to do stupid things because your inventory is going down, Warren Buffett said in an interview with CNBC. Some individuals are not emotionally or psychologically prepared for their stock. Still, we feel that more of them would be if they were more informed about what they were purchasing, which is a firm. Number 10. Search for an economic moat. Like any great investor, Warren Buffett mentioned that it is essential for a company to beat its competitors to achieve success in the stock market. Therefore, Warren Buffett never misses a chance to discuss an economic moat. We know you guys are curious to know about the economic moat, so what is an economic moat? Consider a stronghold surrounded by a medieval moat. Moats were enormous pools that existed around the castle. Their purpose is to keep off undesirable guests and save the castle's inhabitants. This idea also applies to trading occupations. A quality brand and trademarks guard the economic moat of a company against the competition. If competitors choose to attack the corporation via the trench created by its property, they need to be prepared to bear the financial consequences of expensive marketing or private wars. Before investing, do your homework to analyze the intellectual property of a company. Examine any tries by competitors to violate that intellectual property and the method of the selected company investing in response. Number 11. If the situation changes, don't be scared to sell. The most important thing to do if you find yourself in a hole is to stop digging, Warren Buffett famously stated when asked about a loss-making venture. While he would like to own every stock he buys permanently, market conditions change. Buffett bought a large investment in the mortgage firm Freddie Mac a few decades ago, which may surprise you. He opted to sell after realizing the lender's management had begun to take unnecessary risks with the company's cash a few years before the financial crisis. When the financial crisis hit a few years later, it was clear that Buffett had made the correct choice. Number 12. If the value of the stock falls, then sell it. The objective of a value investor is to search for an excellent stock at a fair price. After acquiring the stock at a low cost, the investor calmly waits for its value to grow to a respectable level. Based on your research, you are required to have a reasonable estimate of the reasonable market value of your investment before making a purchase decision. No additional reductions will be made after that price is met. At this point, value investors often sell their shares, earning from the difference between the discount price at which they purchased them and the fair price at which they sold them. You can then spend them on the next opportunity. Everyone wishes they could be the next Warren Buffett, although few people have the financial resources to buy a seat on the board of directors of a publicly traded firm. The Oracle of Omaha can teach you a few things. If you are willing to put in the time to research and have a basic understanding of the stock market, the value investing strategy is a great way to go. Well, there you have it. That's it for the video. We hope you find this video helpful. We value your feedback, so don't forget to share your opinion with us in the comments down below. As always, thank you so much for watching. Please subscribe to the channel, like the video, and press the bell icon for more amazing content about wealth management and finance-related videos. Success is coming your way. Keep your doors open. See ya till the next time.